Welcome back to another episode of Policy and Profits. I'm EJ Antoni. I play an economist on TV, sometimes radio. I am joined by the one and only Mr. Magoo. And Mr. Magoo, you have done it again. What a day you just had. Anthony Esposito of Island Capital Investments. How are you doing, sir?
I am, and I say it sarcastically a lot, but I am winning at life. Thank God. Model nailed it. Definitely was ready for that hit yesterday. S&P took a 3% hit. We did extremely well here. I am very happy, and I am very happy that that we're heading into end of calendar year with a day like that. The day and the month, to be honest, have been fantastic. So the headline on the report today, oh, Magoo, you've done it again. If you were born prior to 1978, you get the joke. The Magoo is Powell, and Magoo's wife is Yellen. So, yeah, doing well, winning at life, and wanted to talk to you about Mr. Magoo, actually. Mr. Powell, Ms. Yellen, there's been some comments out from both, obviously Powell yesterday with the rate cut and the complete bluttering and fluttering of comment afterwards where it made absolutely no sense. We can get into that. But Janet Yellen, we have a clip of her just to kind of recap the woman, the myth, the legend, and then I'd love to hear your comments on kind of where she's gotten us and kind of what she's talking about as she exits stage left. So let's run that clip, and then I definitely want – I can't wait, actually, to hear your input. I've been waiting all week for this. That's her at 22. that was her at a young svelte 22. So I think my favorite picture there was well, there's a good laughing picture. The head back tilt and the laughing like the frat girl, the sorority girl. I thought that was great.
I tell you what, you want a reaction? Here's a reaction. Ding dong, the witch is dead. How about that? Okay. Goodbye. Good riddance. The woman was a disastrous Fed chair. She was a disastrous Treasury Secretary. I mean, I still remember her saying her one regret was that they couldn't create more inflation during her time as Fed chair. Are you kidding me? You couldn't make things worse? That was your regret? It's appalling. And you know, what really is so disappointing to me as somebody who has been in academia is the fact that she went from being, you know, an academic, a supposed nonpartisan, a talented technocrat, if you will, into nothing but a complete political hack. I mean, pure and simple. The fact that she would say, because don't forget, she was Treasury Secretary for a hot minute during Trump's first administration, you know, or excuse me, Fed chair, sorry. You know, she would talk about how under Obama, the horrendous budget deficits that we were having, that was totally fine. As soon as Trump won and was going into office, all of a sudden it was a major problem and had to be dealt with. She's doing the same thing now as Treasury Secretary, where for these years under Biden, I mean, it was all sunshine and rainbows, despite multi-trillion-dollar deficits as far as the eye could see. Now, all of a sudden, the deficit is a problem. Now the debt needs to be dealt with immediately, or it's going to cause huge problems. And sure enough, now she's predicting some kind of financial collapse that's imminent. I mean, give me a break. It's just absolute nonsense. Again, she's nothing more than a political hack.
Yeah. And I agree with you 100%. In fact, the entire administration has filled the cabinet positions and the surrounding staff with politicized hacks. It's a great way to put it. And throw Powell right in that group. And I thought that for a while when he cut the 50 bips before the election in September. That was a complete joke. Yellen has been, and I remember, you know, Summers came out and was pounding the table, and Yellen was pounding the table about MMT, modern monetary theory. And that's kind of what they executed here. But it wasn't this theory. They put it into practice. It's blown up. We're being hurt by it in a massive way, in a generational way. And now as she's exiting the stage, she's kind of waving, walking off, going, I fucked up. That was wrong. Okay, goodbye. I'll be back with the next Dem. Like, what modern monetary theory, and forgive me, correct me if I'm wrong, because this is your side of the aisle for sure. Spend as much as you want, print as much as you want, give away as much as you want. We'll just tax the wealthy or the wage earners, and that will keep inflation down. We're good. Essentially creating a socialized system within the country, but it blew up because it doesn't work. It's stupid. And I will end by saying I think that they're too smart to be this stupid, which leads me down another path, which means it was intentional, which leads me deeper down that path, which is extremely scary that these are the people in charge of essentially our country and our lives. It's not okay. Could you please, am I right with MMT, and why were they so wrong?
Anthony, I think you're absolutely right. Why were they so wrong? That's a good question. It could be because they just heard their own lies for long enough that maybe they actually started to believe them. Maybe they saw the initial spending spree during COVID and into 2021 and said, you know what, inflation hasn't exploded yet. Maybe we should just keep going. And then by the time it finally caught up to them, it was too late.
Yeah.
So, maybe it was a matter of, they started to get high on their own supply, if you will. I'm really not sure. Or maybe they just thought they could kick the can down the road long enough that it wouldn't become a problem until they were all gone, right? Maybe they weren't counting on inflation really getting out of hand until 2025. I'm not sure. But, interestingly, when I would teach my money and banking course, we broke discretionary monetary policy basically down into 7 different schools of thought. And I would tell all the kids, look, discretionary monetary policy is insanely difficult. There is no perfect way to do it, and there's no perfect theory on it. So one of the assignments I would give to them in the final exam was you need to pick one of those 7 schools and defend it, because all of them have upside and all of them have downside. Again, there is no perfect solution, and you can find different points throughout the historical record that show where each of those 7 schools failed. But for one of them, you couldn't find a single instance where it worked, and that was modern monetary theory.
That's amazing. That is amazing.
And so that's why I would tell them, fair warning, guys, if you pick that and you try to defend it on the exam, you're not going to get full credit for that answer because there's just no good way to defend it.
I will crush you.
Exactly. I will crush you, if I can quote Ivan Drago from Rocky.
So far you've quoted NWA and Ivan Drago. Let's keep going.
So, I think it was "I Must Break You," I think was the line from Dolph Lundgren.
That's right.
But anyway, whatever the case may be, it's one of the things I would point out to them was like, look, this is a complete misnomer as far as calling it modern monetary theory. It's not modern. FDR's Treasury Secretary was espousing this stuff. It's not even monetary in nature. It's a way to finance fiscal deficits. It has nothing to do with monetary policy. And then finally, it's not a theory. We've tried it. We've tried it plenty of times before. Again, FDR did it. That's one of the reasons why the Depression was as long as it was. You had Lyndon Johnson and, in his own way, Richard Nixon incorporating different parts of it. And we just tried it again, and obviously it failed again. And that's just here in the United States. It's been tried other places throughout the world, and it has never worked because, as you described, I mean, it's so silly. We can print as much money as we want. So affecting the scarcity of a thing doesn't affect its value. Give me a break.
Yeah. It's pretty. It's been a pathetic run, and the damage done has been it's long-standing. And we've been having some conversations here, and I've been having some conversations with other traders and PMs. And the question is, well, why wouldn't the market continue to rally off of the November bump, Trump bump? Shouldn't there be more upside to the market? And my answer is, the policies will improve. Trump is clearly the candidate we need in office, but it's going to take time. I mean, there's damage. You can't walk into a house that was just on fire and flooded and say, okay, the house is brand new, we're good to go. Like, you need to come in and fix it. These people have literally rolled grenades with no pin into the White House and said, okay, see you later. You're good. Oh, and by the way, I was wrong. This isn't good. Oh boy, here we go.
I must break you.
Hey, LGFG, get on the phone, or I must break you.
and that's why we have the best production staff in the whole world.
Okay? The best. Absolutely.
Believe me, the things that they can just do on a moment's notice. It's incredible. It's the only word for it. It's incredible. So
Now we look at Yellen. I mentioned Summers. I'm not even getting into it because every time he pops up, he's the contraindicator for me. Whatever he says, I take the other side. It's just not a thing.
it's like Jim Cramer.
It's Jim Cramer. Yeah, S Jim. How's that ETF doing today? Probably very well. Now Powell gets up yesterday, and clearly neither one of us are fans. Cuts 25 basis points with literally nothing to say. Like I've never heard him really give a good analysis or a good press conference after, but literally nothing to say. Your mandates are both, according to you and your data, fine. Employment is fine, and prices are stable. You're not fighting inflation, according to you. You're on track, and employment's good. So and GDP, by the way, came in at 3.1% here, whatever that's worth. It's worth. Why would you come in now and cut another 25 basis points? What's the reasoning? When the risk really is to, and he kind of acknowledged this, the risk is now to the upside in inflation, but yet you still cut rates. Now, let's just be clear. Cutting rates, the Fed cutting rates means nothing at this point. The market has truly taken over. Yesterday, the 10-year was up at, the 10-year got to 4.4. The 10-year is at 4.58 right now. So just to put that in perspective, when the Fed cut the first 50 basis points, the 10-year yield, so the rate on the 10-year was at 3.6%. It's now at 4.58% as he continues to cut. Why is he cutting? Doesn't he get what's going on in the game? Or is he really, is it in some way less than ignorant but nefarious? Like, what is he literally trying to create more of an issue for President Trump, the administration, and for us on his way out? Can he be this dumb?
He's either this dumb or this nefarious. I don't know how else you square this circle. And I think one of the reasons why the market tanked as bad as it did, and look, you called it, but I think one of the reasons why that happened was simply the fact that Powell has reverted to where he was like 6 months ago. Half a year ago, they were talking about higher for longer. They were talking about how we're not making enough progress on inflation. We're making progress, but we're not there, right? We're confident, but we need more confidence, whatever that means, because, that's something you can empirically measure, right? The confidence of the members of the governors, the members of the board of governors. The whole thing is just a joke. They completely changed their tune right before the election to make it sound like, well, it's sunshine and rainbows again, and we're going to cut because of that to try to get our preferred candidate across the finish line. Yeah. And now that obviously didn't work, now we're back to, okay, we'll cut again, but it's higher for longer. What? So you're expecting inflation to be worse than you thought. You're expecting interest rates to stay higher than you thought. Why are you cutting today? I don't know if it is literally they are trying, as you described, to roll a grenade without the pin into the White House for Trump. They're trying to create this ticking time bomb for the next admin to defuse. The only other possibility, aside from it being purely politics, is something we've talked about before, how there are hundreds of billions of dollars in unrealized losses on the balance sheets of banks in the United States today. And so if you get rates back down, you help erase or at least paper over some of those losses. Now, it's not going to solve the problem, right? Because you'd have to take rates all the way down to 2 or 3% to do that, which obviously isn't going to happen. But it does ease the pain, especially on some of the major players, right? The JP Morgans, the Wells Fargos. So, look, where we go from here, I'm inclined to believe they're going to take a tougher stance on monetary policy, just like they did during the first Trump admin, by the way. That's one of the reasons why the Trump economic miracle was just that, a miracle. He was fighting the Fed for the first 3 years. Until COVID hit. They were hiking rates. They were running off the balance sheet. They were tightening the screws on him. And yet he still produced pretty significant growth. He's going to have to do that this time around, but he's going to have the added twist of trying to fight the inflation that they just created as well. So it's, look, I think he's the man for the job. Don't get me wrong, but they're really handing him, again, that ticking time bomb that him and his team are going to have to diffuse here. It's not good.
Yeah, no, I agree. And honestly, I think for every job that needs to be done in this country right now and in the Western world, I don't think he's the man. I think he's the only man. I actually don't think
Mm.
there's anyone else that could step into what he's stepping into or have gone through what he's gone through since he came down that escalator and announced for the first term. I don't think there's anyone that could step in and do what needs to be done. And I hope God continues to protect and guide him, because we are in a lot of trouble, and the outgoing administration and the Yellens and Powells of the world are making it harder. So
Right.
I cannot
Right.
wait
And I
for them to
think
leave.
And I think, Anthony, we're not going to figure out just how bad things are, or I should say just how bad things have been, I guess, until we get the next administration. The Philly Fed just a few days ago, they came out with their early benchmark. So, we got, just as some context here, we get those monthly jobs reports, and each month we'll revise the previous 2 months. But then we also get an annual revision called the annual benchmark from the BLS. And that gets done, essentially it's already in the books, but it doesn't get applied to the data until the January report, which will be in February, right? First or second week of February. So we already know we're going to lose about 800,000 jobs when that arrives. However, we just got the early benchmark from the Philly Fed, where they take different labor market data and they try to estimate what the effect is going to be on the eventual annual benchmark process. And for the second quarter of this year, which is not included in that annual benchmark, it goes from March to March. So the benchmark we're talking about that will get incorporated next year, most of that is actually from last year. So there's a big lag there, right? There's a lag of what, a year and a half? All that to say, you're looking at the next benchmark that hits, which would be in February of 26, being another huge downward revision. Now, it'll all be data from before Trump takes office, but it won't actually hit the books until after. So Philly Fed estimates that not only was job growth wildly overestimated in the second quarter of this year, but job growth was actually negative. They think we lost jobs in the second quarter. Now, if you look at all of the initial estimates for those 3 months, the BLS shows us adding over 600,000 jobs. I mean, this whole thing is a fiction. Throw on top of that, the only reason GDP is growing as robust as it is right now is because we're borrowing almost $1 trillion every roughly 100 days or so. That's artificially inflating those numbers. I mean, nothing is as good as it appears. There's a reason why Trump won not just the Electoral College, but the popular vote too. The first president in at least 20 years to do, first Republican in at least 20 years, I think, to do that. He won every single swing state. People everywhere are really mad about this economy. It's because it's nowhere near as strong. It's nowhere near as healthy. It's nowhere near as robust as we've been led to believe. We've been lied to. The problem is we're just not going to find out about all the lies until it's too late.
Well, it'll be according to plan. We'll find out. All the bad news will start to hit while Trump is in office, and then the Dems will turn around and blame Trump, even though it occurred, the foundation for it, and the damage was done during the Biden administration.
Right, exactly.
Yeah. So people are being hurt, and we have a record number of households in the country with exposure to the stock market now after this massive run. And you can mark that back for decades, but we'll mark it back, for the last 3 or 4 years. The next chart I have to put up is actually retail investors' inflows. And we've talked about the extremes that we've been at. We've talked about leveraged derivative products where we're at all-time highs in long index exposure by the institutional investors. We've talked about max highs in interest paid to prime brokers on margin. So that's institutional investors, hedge funds that are leveraging assets they hold in the prime brokerage accounts, posting that as collateral effectively, taking a loan on that at 1, 2, 3, 4, 5 times that amount, and then using that money to go out and buy more stock and get more long. We talked about BOFA wrote an article. I had a stat out a few weeks ago, showed all-time lows, extreme lows in cash on hand versus AUM. We're looking at a real extreme in leverage and a real extreme in long exposure. So this chart came up. I think, did you post this chart? Was this up on your X feed?
No, and I'm trying to remember. I forget off the top of my head where exactly I saw this before I sent it along to you.
Because I know we talked about it. I know it came from you, but we have a rolling 9-week flows into U.S. equities and ETFs in billions. Again, we're at all-time highs. We're at all-time highs for the quarter. We're at all-time highs for the year. So we're continuing to see massive amounts of money, whether it's institutional or retail, roll into the market and get not only roll into the market long, but lever long. So at 2 times, 3 times, 4 times cash, it becomes extremely dangerous. We're at that spot. This was ETF inflows. A lot of people, and I'm going to go into the technicals a little bit because I did have honestly, not all kidding aside, I had a fantastic call heading into mid-month this month, and you kind of started, and I do believe yesterday the 3% drawdown was the start of what I'm looking at. I was positioning very short and long volatility for the first quarter, and honestly was given a gift yesterday with Powell as the market crashed in the way it did. Things just really derailed, and it produced a nice jump in P&L for me. The portfolio was really well positioned. I believe that was just the beginning. But before we get to the technicals of why I was looking at that, what the momentum looked like in the S&P, what momentum looked like in the VIX, as we talk about people and retail investing, the next chart shows what I prefer to look at versus the price to earnings ratio. So PE ratio right now, we're up around 27. To be fair, that is extended. It should definitely be down towards 20 to 16 to say that we're at fair value. The last time we were at, the best buying opportunity of a few generations was, I think, 1980, 1981, and that PE was down at 8. So that's an extreme, and we're at 2 extremes. We're up at 27 now. We were down at 8 at what you could argue was the last real massive generational value buy in U.S. equity markets. What this chart shows is actually more interesting to me because of the inflation story, because of what we're dealing with. These are cyclically adjusted PEs or Shiller PEs. So you take the price to earnings ratio for the S&P, you adjust it for inflation. Okay. So what we're seeing on this chart is we're at about a 38 now, and we're actually double topping at around a 38. The prior peak was the tech bubble in 2000. So we haven't seen inflation adjusted price to earnings ratios this high since 2000. That's saying something, because we had a massive financial crisis in 2008, 2009, where people thought they were going to move into caves with shotguns and canned food. We were talking about the financial system being destroyed. Now, what we have now is we didn't even touch these Shiller PE ratios back in 08. We didn't come near them back in 2016 and 18. We're actually there now. We got there earlier, 2022. We're there now. So a double top at a Shiller PE, which is effectively showing that if you adjust for inflation, we're at extremes. I mean, the tech bubble, and it's really ironic because the tech bubble for the creation of the internet and everything that went along with that revolution, you could probably say that AI is the next great tech revolution. So the last one was the internet, which fueled the 2000 bubble. Now we have AI, which has fueled the 2024 bubble. And the Shiller PEs are very close. I think this is extremely important. And I would not say that we should be waiting for a Shiller PE of 40 plus to say that we're extended. We are extended. So anyone that's talking about valuations is completely out of their mind. We are absolutely extended. If we go further into breadth, so now we go away from earnings, we've adjusted those earnings for inflation to be fair, and we can see how extended we are. We've looked at how extended the long onlys are, the leverage is, and retail money just flowing into the market like it has never done before historically. The next chart I want to look at, which is pretty interesting, is the Mag 7. So if we look at the Mag 7 index, and this is just that those momentum tech names, the Amazons, the Teslas, the Nvidias of the world, for December, we have an outperformance in December of 14% for the Mag 7 versus the rest of the market. Okay, this is the same group that accounts for a third of the earnings in the S&P 500. So you have 7 names accounting for a third of the earnings in the S&P 500, and 64% of the earnings and a third of the market cap. Right? This is not healthy. I don't care. That's where I'll stop the sentence. I don't trade tech here. I'm top down. I'm basics, utilities, industrials, energy. I trade some commodities, crude and gold on the curve. I trade VIX futures on the curve, and I trade the Russell and the S&P futures top down. So I'm kind of like in that space, but I can tell you that as far as breadth goes and being realistic about the market, you do not want 7 names managing the entire market effectively. And if they do, you can make money. You can sit there and it can be coincidence and you can pound the table and say, I'm the smartest guy in the world because I was long Apple, Amazon, and NVIDIA, and I'm killing it. That's great. You're killing it. Not because you're the smartest guy in the world, because we are in a bubble scenario and you have literally been smart enough to just sit and hold. And that's what's going on. On the year, the Mag 7 are up 70%. If we compare that with the S&P equal weight, which kind of makes the S&P large cap a mid cap index. If you think about it that way, you equal weight everybody instead of having these guys pull you up, everybody's equal. And you can compare that with the Russell 2000, right? Small cap, they're at about 10%. And that gain has only come in the last few months. They were flat year to date, heading through August. So you have a 70% gain in Mag 7 versus a 10% gain in equal weight, so call it mid cap, small cap. No one's participating here. There's nowhere to go. We came out in November, right? And everyone said, oh, the market's broadening. Everyone's buying everything. The small caps are catching up. The mid caps are catching up. Industrials look great. Basics look great. Consumer discretionary is still strong. No, what that was it was an enthusiastic Trump rally, which I get, and there was limited place to put capital. So they chased everything. It wasn't investors saying these sectors are good, these market caps are good, the economy is going to be great, inflation's coming down, we're strong. It was them saying we have so much capital and we are so heavily invested Mag 7, I need to put the money somewhere. I'm going to chase small caps. I'm going to chase mid caps. I'm going to chase the industrials. I'm going to chase even energy, which is now obviously with everything else come down, especially after yesterday. But energy took a massive spike. And the thought was that the energy, the super majors and energy across the board, with the exception of midstream, but that's across the board, was going to actually be hurt by Trump because of the fact that we were going to have more supply and because of the fact that margins were going to get squeezed. But even energy ran. Everything ran simply because there was way too much capital out there, which is the hot air inflating this balloon, which is the balloon that's going to burst. Now, I've written over the past couple of weeks, and I've been very skeptical coming out of November. And I will be totally honest. I was very limited in my participation to the upside coming out of the election. And the largest reason was I volunteered for the day to be a poll watcher. And I literally was at the poll from 6 a.m. to 7:30 p.m. I wanted to see the process. I wanted to be a part of the process, and I wanted to intervene when needed. And it should be no surprise that I intervened a few times and actually fixed what looked like it was going to be wrong. But that said, the move up, I kind of was patient and I watched it. I wrote a few things that I just want to go back to quickly because I do issue my morning note. It's not a wordy note, but I like to think it's valuable in what I'm saying. And I don't have my entire model up and I'm not running through all of my analyses, but I do say in the end, I try and give a blurb and a basic chart, what I'm thinking, what I'm seeing, what happened, what I think is going to happen. And here's a picture. So I like pictures. They're nice. They're simple. They're descriptive. On December 11th, I wrote, internals have faded and spot VIX looks poised to spike. The ICAP momentum trend motor model, which is my model, my technical model signal has shifted to negative. I continue to believe that there is more room for the index to fade heading into year end. Risk is skewed to the downside and could potentially accelerate into Q1. On December 16th, I wrote, spot VIX and term structure remain in a risk on posture, meaning buy stock. But I see a high probability of that changing aggressively over the near term. So let's talk aggressive. Yesterday, spot VIX rallied 73% on the day. So that to me, I'm going to say that if you read it and you took anything away from it, a 73% rally in the VIX. I happen to trade the VIX. You can't trade the index. So I happen to trade front month and second month futures. There was a massive 20 to 25% rally in those contracts just yesterday. That's what I was talking about in an aggressive spike. So the model my motor model, is evaluating a few different inputs on momentum and trend. And what I saw coming into last week and then heading into the announcement. And let's be clear, the announcement might have been the catalyst. It might have been the headline. The headlines are interchangeable. The market knew where they wanted to go, and I saw it developing. What I saw was a great downtick and accelerating degradation in positive internals on the S&P and the Russell. So they were getting more negative and looked like they were going to fade. And what caught my eye is I have two models that run off of the VIX and term structure. One is off spot VIX and one is off term structure. Term structure being spot VIX rolling out to front month futures contract, rolling out to second month, third month, fourth month. What I saw was the indices breaking down in my model, and I started to catch a very strong buy signal in the VIX turning up. So we know that as volatility rolls up and spikes up, markets normally drop pretty hard. So I saw two things happening that actually confirmed each other, and it started to get pretty aggressive heading into this week. And that's why I was positioned the way I was heading into Powell. Powell just happened to be coincident into the aggressiveness of the move down, and in the fact that he spoke and kind of drooled on himself while he was trying to explain what he was doing and why he does it, which is fine. I should actually send him a bouquet of flowers and a thank you card because it was a phenomenal day and trade. However, the bottom line is yesterday was the beginning of what I see developing as far as downside move in the market. Now, I wrote today, I would not be surprised if the S&P cash got back up towards 6,000. We're at 59.04 right now. We're at a low of 58.64. That was my support level, which I actually have had on the chart since November 6th, by the way. So this is kind of cool. And then I'm going to move on. We hit a low yesterday of 58.67. On November 6th, I marked support at 58.64, 3 points from where that low hit yesterday. So this was one of four support levels I had marked. 3 were broken during yesterday's sell-off. This one held. There is a gap lower, which reaches down to 5,800 on the S&P cash. I do think that gap will be filled, but I do think we could see some upside heading into year end. Seasonally, there's going to be dip buyers. There's going to be those that blame it on Powell only and say, I'm still sticking with my Mag 7. We're pushing this baby higher. I got to invest my cash. I'm going to lever up. I'm going to be there. Ultimately, those will be more beads in the bucket. That bucket will get flipped at an appropriate time out in the future, and that will be more beads and more supply to overcome demand to bring us down to lower levels. So I think yesterday was the beginning of what we're going to see. I think topping is a process. We're in that process. Just beware. That was wordy, but I'm done.
No, I love it. And Anthony, to your point, I mean, we have so many different economic indicators that don't support today's prices, right? Despite the fact that there's been you talked about the Trump bump, there's been this huge surge in optimism. You know, the small business optimism index surged by the most since the last time he was elected, since November of 2016. You can look at the different regional Federal Reserve banks, the surveys that they do. The manufacturing numbers are surging, but only really in terms of future expectations. The current conditions continue deteriorating. In other words, things are still getting worse out there. Yeah. And so, I get it. Stock prices are not based off of today's earnings. They're based off of future earnings. I totally get that. But at the same time, how far into the future do you have to go? Yeah. Right? But before you're talking about, okay, it's not tomorrow's earnings. It's not 6 months. It's not a year. It's 5 years. I mean, really, how far into the future do you have to go? And I think we're looking at an increasingly long time horizon there before you can justify, these prices. And that's why you were spot on with your call.
Yeah. And I think the further out you need to go, the more uncertainty there is. And anyone that would argue that is lying. You can model out the next quarter. You may be able to model out the next 2 quarters. If you start talking about, multiple quarters out or years out, the uncertainty, it's endless. So
right.
We're in that spot. I agree with you 100%. And I was actually looking at that NFIB survey. We spent Biden's entire term beneath the 50-year moving average. And I think I don't think that's happened often. I won't say it's never happened before, but we spent 3.5 years with that survey, the small business survey, below the 50-year moving average. And on Trump's win, the next time they took the survey, we saw the largest bump back up in 3.5, 4 years, which brought us back above to kind of like everybody can breathe. So I agree with you, man. The fundamentals of the economy, and as far as growth, as far as debt, as far as employment, as far as manufacturing, as far as rates, like this stuff's not supportive right now. And you know, we've even had the conversation of the KFAB where everyone's kind of playing along and like, yeah, everything's all right, but everyone knows it's not all right. Well, yesterday was an example where people were like, yeah, fuck this. Like, I'll come back tomorrow, but today I'm out. And that's really what happened. And I think it's the beginning of a bigger picture. The weekly and the monthly signals are, you know, starting to bend weekly more than monthly, obviously. So I'll roll out from daily to weekly to monthly. But the longer term signals are not as healthy as they looked a year ago or 6 months ago. And I think it's something to pay attention to. Policy side, man, you're always spot on. I love the analysis. I love the NWA and Ivan Drago references today. I definitely, I'm going to keep them with me. I might actually flip the record on while I finish out the day here.
Well, hey, my man, you are nailing these trades. So I tip my hat to you, good sir.
I appreciate it. It's like a lucky squirrel, right? It's a lucky squirrel finds a nut. I'll take it and I will stash it away and move on to the next one. But it's been a pleasure, my friend. Thank you very much for carrying the weight during this half hour or so that we chat. I appreciate it. And as always, I look forward to seeing you next week.
Till then, Anthony.